In 2026, the average American household needs to earn $117,000 per year just to afford the median-priced home. The median household income is $77,000. That gap is not a housing problem. It is a structural fracture in the foundation of how this economy is supposed to work. And no one in Washington is telling you how wide that fracture has actually become. This is not about interest rates being too high. Interest rates have been higher before and people still bought homes. This is not about inventory being too low. Inventory is rising in dozens of markets across the country right now. What is happening is something more permanent, more mechanical, and more dangerous than any single data point can capture. The mortgage rate did not kill the American dream on its own. It simply exposed the fact that the dream was already on life support, surviving on the artificial oxygen of 0% money that the Federal Reserve can never give back. Before we get into the specific mechanics of how the rate structure has permanently repriced the cost of entry into the middle class, understand what this channel is about. This is not fear. This is not politics. This is the architecture of the financial system laid out in plain language. We follow the capital, we follow the incentives, and we tell you what the institutions already know but will never say out loud. Let us start with a number that almost nobody is talking about. The monthly mortgage payment on a median-priced American home in 2026 is $12,900 before you add property taxes, homeowners insurance, and private mortgage insurance. When you add those three items, the all-in monthly cost of owning that median home crosses $3,800. For a household earning the median income of $77,000, that monthly payment represents 59% of their gross income. The standard underwriting rule used by every major bank in the country says that your total housing costs should not exceed 28% of your gross income. The gap between 28% and 59% is not a market inefficiency. It is a declaration that the system has broken and has no mechanism to fix itself without a destruction of either prices, rates, or both. Now here's where it gets structural. Mortgage rates are not simply a number the Federal Reserve controls by turning a dial. They are derived from the yield on the 10-year Treasury bond, which is itself a function of what global investors demand to lend money to the United States government for a decade. And in 2026, those global investors are demanding significantly more than they were 5 years ago because the arithmetic of American debt has changed in a way that cannot be reversed by a single Federal Open Market Committee meeting. The United States government is currently spending more on interest payments on its own national debt than it spends on the entire defense budget. The Congressional Budget Office projects that interest costs will reach $1.6 trillion annually by 2028. When the government is the largest single borrower in the bond market, competing with every home buyer, every corporation, and every municipality for the same pool of savings, the price of money cannot come down structurally. It can only come down temporarily, in a crisis, when the economy collapses and demand for credit collapses with it. That is not a soft landing. That is a recession, and recessions do not save your home purchase. The Federal Reserve cut rates in late 2024 and early 2025. Most Americans assumed that this meant mortgage rates would follow. They did not. The 30-year fixed mortgage rate remained stubbornly above 6.5% throughout 2025 and into 2026, defying the conventional wisdom that had guided homebuyers for a generation. The reason is a spread problem that reveals exactly how the system has been rewired against the average borrower. The spread between the 10-year Treasury yield and the 30-year mortgage rate, which historically ran at about 1.7 percentage points, has blown out to over 3 full percentage points. This extra cost is being charged to you by the mortgage bond market, which is pricing in prepayment risk, credit risk, and the uncertainty of a Federal Reserve that no longer holds trillions of dollars in mortgage-backed securities on its balance sheet. Between 2020 and 2022, the Federal Reserve bought $1.4 trillion worth of mortgage-backed securities, becoming the single largest buyer in the market and artificially suppressing the yields that determine your mortgage rate. They are no longer buying. In fact, they are letting those holdings mature and roll off their balance sheet, removing a massive source of demand from the mortgage market. The buyer of last resort has left the building, and without that buyer, the mortgage market must find real investors willing to hold these bonds at a return that compensates them for actual risk. Those investors want more, and you are the one paying for it. This is the mechanism that nobody explains clearly. When the Fed was buying mortgage bonds, they were effectively subsidizing your interest rate. Every American homebuyer from 2020 to 2022 benefited from this subsidy, locking in rates at 2.65%, 2.8%, or 3.1%. There are currently 14.5 million homeowners in the United States sitting on mortgage rates below 3%. Another 12 million have rates between 3% and 4%. Combined, those 26 million households represent over 40% of all outstanding mortgages in the country. And virtually none of them will ever voluntarily sell their homes and take on a new mortgage at current rates. This is what economists call the lock-in effect, and it has created the most frozen housing market in the history of modern real estate data. The lock-in effect is not just a curiosity, it is the operating mechanism of a housing market that is split into two entirely separate realities. There is the existing home market, where sellers with low-rate mortgages refuse to list, keeping inventory artificially thin and prices artificially elevated in most markets. And there is the new construction market, where builders are the only sellers motivated to move product, and they are moving it by offering mortgage rate buydowns that effectively subsidize buyers to the tune of $30,000 to $50,000 per transaction. This subsidy is baked into the price of the home. You are paying for your own discount. And when the builder stops offering buydowns because their margins get squeezed, the demand for new homes collapses with it. Existing home sales in 2025 fell to their lowest annual level since 1995, a year when the United States had 75 million fewer people. This is not a slow market. This is a market that has medically flatlined while the vital signs machine is still beeping. Transaction volume has collapsed by 38% from the peak, and what little volume remains is heavily concentrated at the extremes. Cash buyers who need no mortgage, and distressed sellers who have no choice but to transact regardless of the rate environment. The middle of the market, the first-time buyer, the family moving up, the retiree downsizing, has been priced out or locked in. The engine of American housing liquidity has seized. Here is what seizing liquidity does to a market over time. When people cannot move, labor mobility collapses. A software engineer in San Francisco who owns a home at a 2.9% rate cannot afford to take a job in Austin because the moment they sell and buy, their housing costs double. So they stay. Employers in growth markets cannot attract talent because talent is financially handcuffed to their existing properties. Regional economic development slows. The dynamism that made the American economy the most productive in the world was built on the ability of people to move where the opportunity was. That ability is now a luxury tax that most households cannot afford to pay. The ripple effects move directly into the rental market, which has its own structural crisis developing simultaneously. When would-be buyers cannot buy, they rent. This additional rental demand was supposed to support rent growth and therefore support the valuations of the multifamily apartment sector, which saw trillions of dollars of investment flow in during the zero-rate era. But something went wrong with that calculation: supply. Between 2021 and 2024, developers broke ground on more new apartment units than in any four-year period since the 1980s, all of them financed with the cheap floating rate bridge loans that seemed sensible when the Fed funds rate was 0.25%. Those loans are now repricing at 7%, 8%, and in some cases higher, against properties that are experiencing flat or declining rents because all that new supply is hitting the market at the same time. The National Multifamily Housing Council estimates that over $150 billion in apartment loans are currently in distress, meaning the properties cannot generate enough cash flow to cover their debt service at current rates. This is not a San Francisco problem or a New York problem. It is a Phoenix problem, an Austin problem, a Charlotte problem, and a Nashville problem. The exact markets that absorbed the most migration and the most capital during the pandemic boom are now being flooded with new supply, just as the buyer pool of high-income remote workers has stabilized or shrunk. Vacancy rates in Austin, Texas, which attracted billions in multifamily investment on the back of tech relocation stories, have risen to 14%. The national average vacancy rate that triggers rent declines is considered to be around 7%. Austin is double that. When apartment loans go bad, the lenders absorbing those losses are not the Wall Street megabanks with diversified global portfolios. They are the community banks and regional lenders that funded local development. There are currently 63 banks in the United States with commercial real estate concentrations that exceed 300% of their total capital, a threshold that regulators flag as a systemic risk indicator. The FDIC's own problem bank list, which tracks institutions at elevated risk of failure, has been growing quietly for 6 consecutive quarters. The extend and pretend strategy that banks are using to manage these losses, granting loan extensions rather than forcing foreclosures, buys time but does not create value. The losses are real. They are just being deferred into a future quarter when market conditions are presumably better. Except market conditions are not getting better because the rates that caused the original problem have not come down enough to solve it. The insurance crisis is the pressure valve on top of this already pressurized system, and it is being almost entirely ignored by the mainstream financial press. State Farm, the largest property insurer in the United States, announced in 2023 that it would stop writing new homeowners policies in California. Allstate followed. Farmers Insurance withdrew from Florida. These are not minor players. These are the backbone of the residential mortgage system because federal regulations require that any home with an outstanding mortgage must carry hazard insurance. No insurance means no mortgage. No mortgage means no sale. No sale means price discovery via cash buyer only, and cash buyers in distressed markets pay 30 to 50 cents on the dollar. The mechanism by which climate risk reprices real estate is not the flood itself. It is the insurance company's model run 18 months before the flood. When Swiss Re and Munich Re, the global reinsurance giants that backstop your State Farm policy, update their catastrophe models to reflect new loss projections for hurricane, wildfire, or flood, they raise the price they charge State Farm to reinsure their book. State Farm passes that cost to the consumer or exits the market. In Florida right now, the average homeowner's insurance premium has risen to $6,000 per year. In some coastal counties, it exceeds $15,000. Add that to a $2,900 principal and interest payment and a $500 property tax escrow, and you are looking at a $20,000 annual housing cost on a median-priced home. For a household earning the Florida median income of $67,000, that represents 30% of gross income consumed before you have paid for food, healthcare, transportation, or childcare. The math does not produce homeowners. It produces people who leave. The population data confirms the departure. Florida gained 400,000 net new residents in 2022. In 2024, that number dropped to 85,000. The Great Sunbelt migration that inflated housing values, supported municipal bond ratings, and justified billions in new construction financing is decelerating. The fundamental value proposition of owning real estate in a climate-exposed region is being repriced in real time by actuarial tables, not by ideology. Insurance companies are not political. They are probabilistic. When their models say a region is too risky to insure profitably, they leave, and no government mandate has ever successfully forced a private insurer to stay in a market where they are losing money. The uninsurable future is arriving on a specific zip code basis, and the financial system has not priced that transition. Now step back from the individual household and look at the balance sheet of the entire economy, because that is where the story becomes most consequential. American household net worth reached $156 trillion in 2023, the highest nominal figure ever recorded, but 68% of that net worth is held by the top 20% of earners. And within the real estate component, which comprises roughly $45 trillion of total household wealth, the distribution is even more skewed. The home ownership rate for households in the top income quintile is 91%. For households in the bottom quintile, it is 41%. The wealth that American families depend on for retirement security, for intergenerational transfer, for collateral against life emergencies is overwhelmingly concentrated in an asset class that the next generation cannot access at current prices and rates. This is not a temporary affordability problem waiting for rates to normalize. The demographic math ensures the problem compounds. There are 72 million millennials in the United States, the largest generational cohort in American history, now in their peak household formation years between 28 and 43. The generation behind them, Gen Z, numbers 69 million, and is entering the job market with median starting salaries that have risen 22% since 2019, but into a housing market where prices have risen 47% in the same period. The gap between wage growth and price growth is not closing, it is widening, and the political consequence of an entire generation locked out of the primary wealth-building mechanism of American society is not something that resolves quietly. The homeownership rate for Americans under 35 fell to 37.4% in the fourth quarter of 2025, the lowest level since the Census Bureau began tracking the metric in 1982. Every percentage point decline in the homeownership rate among younger cohorts represents a transfer of that housing stock from owner-occupied to investor-owned rental. Between 2018 and 2024, institutional investors and large corporate landlords acquired approximately 450,000 single-family homes in the United States. That number represents less than half of 1% of total housing stock, which is why economists often minimize the institutional investor narrative. But the concentration of institutional buying is not spread evenly across the country. In Atlanta, Phoenix, Dallas, and Charlotte, institutional buyers accounted for 20 to 25% of transactions in specific price bands during peak buying periods. The marginal buyer in those markets, the buyer setting the price at the clearing point, was a yield-hungry institution with access to institutional rate financing, not a young family trying to build equity. That institutional buyer set prices that reflected their return requirements, not the affordability ceiling of local households. Local households now own less of those neighborhoods than they did 6 years ago. The downstream consequence of the ownership gap is a retirement crisis that the pension system is not structured to absorb. The Social Security Administration projects that the Social Security Trust Fund will be depleted by 2033, at which point incoming payroll taxes can fund approximately 79% of scheduled benefits. Congress has known this for years and has not acted because the political cost of either raising the payroll tax or reducing benefits is too high in any individual election cycle. The result is a structural funding gap that is being denominated in the retirement accounts of 70 million Americans who depend on Social Security for more than 50% of their income. When housing equity is also unavailable as a retirement asset for the portion of the population that cannot access home ownership, the dual failure of the pension system and the housing market creates a retirement poverty wave that the social services infrastructure of American cities is not remotely prepared to manage. Healthcare is the accelerant poured onto this fire. The United States spent $4.9 trillion on healthcare in 2024, more than the entire GDP of Japan. The per capita cost is $14,570 annually. The median American worker receives employer-sponsored health insurance with an average family premium of $23,768 per year, of which the employee pays $6,575 on average. That employee contribution represents 8.5% of median household income before you have paid for food, rent, transportation, or anything else. Total healthcare cost burden, including premiums, deductibles, copays, and out-of-pocket maximums, consumes approximately 18% of the pre-tax income of a median American household. Add that to the 59% that housing consumes at current mortgage rates, and 77% of gross income has been consumed by two line items: the discretionary economy, the spending that drives corporate earnings, retail sales, and employment growth in services, is being funded by debt, not income. Credit card balances crossed $1.17 trillion in 2024, and delinquency rates on those balances have risen for 7 consecutive quarters. There is a concept in credit analysis called debt service capacity, which measures whether a borrower's income is sufficient to cover the minimum payments on their outstanding obligations without drawing down savings. By this measure, the bottom 40% of American households by income are technically insolvent. They are servicing their obligations by borrowing more, not by earning more. This is the mathematical definition of a Ponzi structure at the household level, using new debt to service old debt. It works for an extended period as long as credit remains available and affordable. The credit availability question is the one that every regional bank loan officer is watching in real time. And what they are reporting is a progressive tightening that does not show up in the Fed's aggregate data because the macro numbers are still averaging in the strength of the top 20%. The labor market tells the same bifurcated story. The headline unemployment rate in early 2026 was 4.1%, well within what economists consider the range of full employment. But the composition of that employment has shifted in ways that matter enormously for the housing market. Full-time employment with benefits as a percentage of total employment has been declining since 2022. The growth in jobs has been concentrated in part-time, gig, and contract work that does not qualify for employer-sponsored benefits and, critically, does not qualify for mortgage underwriting purposes under the same standards as W-2 salaried income. A self-employed contractor earning $120,000 per year must show 2 years of tax returns to qualify for a mortgage, and their net income after business deductions may be $70,000. The same person as a salaried employee qualifies immediately on their gross. The shift toward non-traditional employment forms is not just a cultural story about workers preferring flexibility. It is a mortgage qualification story that is systematically excluding a growing percentage of the workforce from home ownership regardless of their actual income. Construction is not coming to save the situation on a timeline that addresses the current crisis. The United States has underbuilt relative to household formation by an estimated 3.8 million units over the past 15 years, according to analysis by Freddie Mac. The National Association of Realtors puts the figure closer to 5.5 million. The range of disagreement itself tells you that nobody has a firm grip on the actual scale of the shortage. What is agreed upon is that closing it requires permitting, building, and financing hundreds of thousands of new units per year above current production for a decade. But construction starts fell 9% in 2025 as builders faced the combination of elevated material costs, tight labor supply in skilled trades, rising lot costs in desirable markets, and most importantly, a buyer pool that cannot qualify for the mortgages needed to purchase at prices that make the construction economics work. A builder cannot profitably build a single-family home in most major markets for less than $350,000 fully burdened. A household qualifying for a 7% mortgage under standard debt-to-income underwriting can afford a purchase price of approximately $280,000 at the median income. The construction economics and the affordability economics do not currently intersect. There is no market rate solution to that gap without either substantially lower rates or substantially lower land and construction costs, neither of which is on the near-term horizon. The policy options available to address this crisis are being discussed in Washington, with the seriousness usually reserved for municipal zoning board meetings. The Biden administration launched a series of housing affordability initiatives in 2024. The Trump administration has proposed different interventions in 2025 and 2026, including deregulation of federal land for housing construction and immigration enforcement measures that affect the construction labor supply. The construction labor force in the United States is approximately 23% foreign-born, with undocumented workers representing a material share of subcontract framing, drywalling, and finish work in states like Texas, Florida, and Arizona. Any significant reduction in that labor supply does not raise wages fast enough to attract domestic workers to replace it. It delays projects, raises costs, and ultimately reduces the supply of new homes below what the market needs. This is not a political observation. It is a supply chain observation. Labor is a material in construction just as lumber and concrete are, and when any material becomes scarce, the output contracts and the price of the remaining output rises. The Federal Reserve is watching all of this develop with the full awareness that their policy choices are directly implicated. The hiking cycle that took the Fed funds rate from 0.25% to 5.5% between March 2022 and July 2023 was the most aggressive tightening sequence since Paul Volcker broke the back of inflation in the early 1980s. It succeeded in bringing the headline Consumer Price Index down from 9.1% in June 2022 to approximately 2.9% in early 2026. But the transmission of that tightening into the real economy was uneven in ways that the models did not fully anticipate. Sectors with long-duration financing, real estate first among them, took the full force of the rate shock, while the sectors with the most leverage, the government itself and large corporations with access to fixed-rate bond markets, were relatively insulated. The people who had the least ability to absorb higher borrowing costs, households at the margin of affordability, were the ones most directly harmed. This asymmetry of impact is structural. It is embedded in how the transmission mechanism of monetary policy actually works. The Fed is now in a position where cutting rates aggressively enough to restore housing affordability would risk reigniting the inflation that they spent 3 years and enormous economic pain to suppress. The bond market would not passively accept a return to negative real interest rates. Foreign holders of U.S. Treasury debt, who own approximately $8.5 trillion of it, would accelerate the diversification away from dollar-denominated assets that is already underway. The dollar would weaken, import prices would rise, and the CPI would reverse. The Fed knows this, which is why, despite the clearest affordability crisis in modern housing history, they are not cutting aggressively. They are managing decline, not engineering recovery. What happens next is not a collapse that announces itself with a single dramatic event. It is a compression that operates on multiple time horizons simultaneously. In the near term, the inventory of homes for sale continues to rise slowly as forced sellers, driven by job loss, divorce, death, and financial distress, overcome the gravitational pull of the lock-in effect. Transaction volume stabilizes at depressed levels. Price growth in most markets stalls and turns modestly negative in real inflation-adjusted terms, even if nominal prices hold in headlines. The psychological experience of home ownership stops feeling like wealth accumulation and starts feeling like expense management. In the medium term, the wave of commercial real estate loan maturities hitting in 2026 and 2027 forces recognition of losses that have been deferred through extend and pretend. Regional banks, which hold 70% of that debt, are forced to raise capital, restrict lending, or in the most stressed cases, absorb FDIC intervention. The credit tightening that results from regional bank stress reduces the flow of new financing to developers, small businesses, and consumers in the geographic markets those banks serve. The communities most dependent on regional banking, mid-sized cities, suburban growth corridors, rural markets, experience a localized credit crunch even as headline national credit conditions appear manageable. The insurance withdrawal from climate-exposed markets accelerates. The list of zip codes designated as high risk by the major reinsurers expands each year as the actuarial experience accumulates. Property values in those zip codes reprice to reflect the cost of self-insuring or going without insurance, which means they reprice to the level that a cash buyer would pay, knowing they carry the full physical risk. That repricing does not happen overnight. It happens whenever a major insurer announces a non-renewal wave, whenever a hurricane or wildfire season produces losses that force the state-backed insurer of last resort to raise premiums, whenever a mortgage servicer begins requiring force-placed insurance at 3 times the market rate for a lapsed policy. Each of these events is a step function repricing in specific markets that gradually makes itself visible in aggregate national data. The retirement funding gap widens as the generation locked out of home ownership in their 20s and 30s arrives at their 60s, without the primary asset that previous generations used to fund their later years. The median net worth of Americans between 65 and 74 is $410,000, of which roughly 60% is home equity. If the incoming cohort of retirees has significantly less home equity, the fiscal pressure on Social Security, Medicare, and state-level social services programs intensifies precisely as those programs are already facing structural funding deficits. None of this is a prediction of systemic collapse. It is a description of a system under compounding stress where multiple feedback loops are operating simultaneously and each one incrementally worsens the conditions for the others. The mortgage rate did not cause this alone. It revealed the brittleness of a structure that was built on assumptions of permanent cheap money, permanent climate stability, permanent demographic growth into home ownership, and permanent global appetite for U.S. Treasury debt. Each of those assumptions is now in question at the same time. The intersecting stress of rate, insurance, demographics, labor market composition, and public finance is not a crisis. It is a repricing, a slow, structural repricing of what it means to own property in America. The data on new mortgage applications, the leading indicator of future home purchase activity, shows that the buyer pool at current rates and prices consists almost entirely of households in the top income quartile. First-time buyers as a share of total purchase mortgages fell to 24% in 2025, the lowest level ever recorded by the National Association of Realtors, which has tracked the metric since 1981. The American housing market is not crashing the way 2008 crashed, with sudden, widespread foreclosures and price implosion. It is closing its doors to the households for whom it was the primary vehicle of upward mobility and becoming increasingly the domain of those who already have capital, already own assets, and are using the market as a mechanism to expand what they already hold. The data will continue to unfold on this timeline, whether or not any individual policy intervention succeeds. Rate decisions, construction initiatives, insurance regulation, zoning reform, and tax policy all affect the trajectory at the margin. But the structural break in affordability, the $40,000 annual income gap between what a household needs to afford the median home and what the median household earns, does not close without a decade of either wage growth that substantially outpaces housing cost growth, or housing cost reduction that arrives through some combination of price correction, rate decline, and insurance stabilization. That is not a forecast of doom. It is the arithmetic of the current position. Track the data as it comes in. The credit markets, the regional bank earnings reports, the insurance carrier filings with state commissioners, the Census Bureau's quarterly home ownership rate, and the monthly existing home sales figures from the National Association of Realtors all tell the story of this system in real time. The information is public, and the direction it is pointing is consistent. The question is not what is happening. The question is what your own position relative to this system looks like when the next layer of data arrives.